Do you use short?
I started out as a short seller back in '93. My first job on Wall Street was an analyst for a short seller. And if you're gonna work as an analyst, starting out as a short seller is the best job to have because you really do research. You talk to competitors, you talk to suppliers, you talk to customers. You grow very skeptical. You learn all the financial ratios. Like if a day sales outstanding goes from 60 to 90 days, there's stuff in the channel, right? And so it's a great way to start out, but it's a tough way to make money in the long run. Now, as a product, if you were selling a product like to a fund of funds or something like that, it's a great product to sell because it's the only category. You have all these categories out there. You have like venture capital, you have longs, you have emerging markets, and as a category, short selling is a great product to sell because if you're a good short seller, you will lose less money than the S&P is up. And so you outperform your index, which is harder to. It's easier to outperform your index as a short seller, i.e., the negative of the S&P, than it is as a long, because there's just more inefficiency in the short selling market, and you generally are a better analyst because you're doing more work. But on the other hand, there's just so many things working against you as a short seller. Let's say you're right as a short seller. It doesn't mean you're going to get paid. All those guys were right about Porsche, Volkswagen being massively overvalued back in 2008. When every other short was working in the world, people were getting squeezed on the Porsche short. People were short Volkswagen because Porsche was doing some kind of takeover. Porsche squeezed all the Volkswagen shorts. And so they were right fundamentally. Volkswagen was way expensive, but everyone got called in at the wrong time. They had to tender their shares at the high point of the market. They were in a weak position because they had borrowed something. So you could be fundamentally right, but the mechanics, the actual mechanics of borrowing something, can kill you. Risk management is much harder in short selling. Let's say if you're in a long and you bought it at 70, it goes down to 50. You buy more. That's how your risk management is. You feel better about buying more, right? Because you got that much better of a bargain. You thought it was worth $1, you start buying at 70, it goes to 50. You buy more, you feel better, you're going to be richer. Let's say it's the opposite. You find something that's trading at 50 and you think it's worth 20, but it goes to 90. So now you think you go back 90 to 20, you're going to be richer. No, you can't. The way you run a portfolio, you have more exposure now. You have to cover at 90. So you're doing the exact opposite of what you should be doing. You should be adding to your position if you're long. But as a short seller, you have unlimited exposure. So you have to actually cut your losses, even though it's a better short. The other thing about shorting is that the company knows it's overvalued. They're promotional. And they could do things that actually add value. They could issue shares, which adds some heft to that balance sheet there. Or if you're American Online, you can go buy Time Warner, which actually brought a lot of value to American Online shareholders, but not to Time Warner shareholders. So you can actually buy a real asset, is what I'm saying. So if you were short at AOL, I guess you would have made money if you carried on that short to Time Warner. But it's just much tougher. And the other reason I don't like shorting is the tax treatment is totally different. It doesn't matter how long you're short a position. You're always going to be taxed at a short-term rate. Whereas if you're in a long position, you might, if you hold it over here, you got a much better tax treatment. And also, if you're right on a long, you only have to be right once. Those guys who bought Warren Buffett in 1965, that's all they had to do. That's it for the rest of their life. If you were right on Enron, you feel fantastic. You were right. You were, you got called an a-hole on the conference call, which is a badge of honor. Richard Grumman got called out on the conference call, and it makes for great stories, right? But next day you got to find another short, back to work, right? And so it's a very hard thing. But as a job or as a product, it's a great place to start and it's a great product to sell. But as someone who actually wants to make money for their own purposes, just to buy and hold, it's a tough way to do things.
That's a great analysis on why short is not a good business.
When I started business in October, I worked for Tyndall Partners for 2 or 3 years, and a very good hedge fund run by Jeff Hallis. And they had a neutral hedge fund, and they were shorting, and I was doing some shorting for them, and I shorted for Michael Katz at Raynard and Glenrock. So I had some very good experience with shorting. And when I started my fund in '98, I was going to be a real hedge fund. I was going to go out there and raise assets and short and stuff like that. And I had a relationship with Wall Street and all that kind of stuff, which is a very good short selling service. And then, what I realized is like you lose sleep. When all these internet, I don't know, you guys might be too early, you guys might be too young to remember this, but there was this huge internet craze back in 2000 and '99. And I was short all these things in I think the fall of '99 and the spring of 2000. And all they would do is put out a press release, and the stock would go up 10%. There's no fundamentals at all. And you would just live with this day in and day out. I'd lose 100,000 here, 50,000 there. I was only running $2 million, and it was a lot of money. And eventually I just said, I can't take it. I'm just covering. Everything I covered in the spring of 2000 was bankrupt within 18 months.
Right.
All of them were zeros. But it's just insane. You just lose sleep, and you say, I just never want to be in that position again. And it's just much easier. I mean, now my portfolio turns 20 to 30%. It's just easier to build value in the long term.
I shorted the housing stocks at the peak.
Right.
Same story. You're right. But they just put out news, earnings, it goes up and up. If I have hold on, you would double your money.
Yeah, and
those days are the hard days.
And not only that, but whenever you lose money on a position, whether it's long or short, you go back and make sure your assumptions are right. You begin to doubt yourself. What was the mistake I made, right? And that takes time. The time you should be spending on the longs, right, or something else. In an inordinate amount of time and emotional commitment in terms compared to the payoff. I mean, it's fun. Intellectually, it's the funnest thing. When you're right and everyone else is wrong, it's the greatest thing in the world. That 1 or 2 days when Exxon goes, when Enron goes to zero, or what was I short? Like when the Network Associates, when I was short that, when that went down, or something like that. When they miss, it's great. You feel like you're the smartest guy around, but it doesn't make you any wealthier in the long run. So, yeah.
What, in terms of your portfolio, long only you said, are you analyzing those, taking back and going, reviewing your assumptions once a quarter, once a year?
Every time a 10K comes out or financial or 10Q comes out, I update the numbers. I mean, I just read whatever's on Thompson 1. In terms of my modeling, I mean, I don't do any modeling. I assume that if 20 analysts are covering Google, that they know more about what that company's going to earn than I will ever know what that company's going to earn. And that's what I use. I just use the earnings estimates from Wall Street generally. But if there's something going on that I know is temporary, there's a lot of goodwill, then I'll add that back to the EPS or something like that, or things like that. But yeah, I review them. But you probably review them more when they go down and try to figure out if you're wrong. So what you miss.
Do you use a spreadsheet?
Yeah. And I'll send that look-through spreadsheet to you, so you can pass it around to you as a template to your students.
How many securities do you think, as a one-person shop, you could reasonably cover, without overly stressing yourself out, giving yourself enough time to, analyze them, look at the balance sheets when they come out, obviously it takes X number of hours per stock, kind of as you're going through.
Yeah.
Do you think there's a limit?
Yeah, there's a limit. But I mean, you probably don't need. I think the scientific studies or the academic studies say you don't need to own more than 15 stocks to get the same diversity as you do if you own 30. So, I mean, but you just might have a lot of different interests. Generally, I own my largest top 10 positions are probably 50% of my fund, and then I have token positions in certain situations I just want to keep track of, make sure I keep track of them, and things like that. So I probably have 30 positions. But you read the quarterly statements, the balance sheets and stuff like that, and you look at the research reports to see if you're missing something, and then you just it takes, I don't know, 2 or 3 hours per company per quarter. But what's